Hello, everyone. It is absolutely fantastic to have you here with us today.
It really is.
Thank you so much for tuning in to watch or, listen to this breakdown. We have a massive session ahead of us. And honestly, if you're interested in the nuts and bolts of the global economy, you are in the right place.
We really do have a packed agenda. It is always fascinating to peel back the layers of these corporate calls because, that is where you find the signal and the noise.
Exactly. So let's set the stage. It is February 7th, 2026. We are looking at the Q4 2025 earnings call for ArcelorMittal.
Yeah.
Now, usually you think steel earnings are just about volume up, volume down, but looking at this transcript, something feels different. There's a shift in the air.
That is the key takeaway right from the start. It isn't just about, selling steel anymore. It's about the structure of the market itself. Management is laying out a case that the playing field, specifically in Europe, has fundamentally changed.
We are going to unpack exactly what that means. So here's our game plan for today. We'll start with a summary of what management actually presented, the CEO, ArcelorMittal, and his team. Then we're going to dive right into the Q&A session. We have to be thorough here because we're going to go through 10 specific analyst exchanges. That is where the real details on strategy and trade protection came out.
A Q&A is definitely where the nuance lies this quarter. It's where the rubber meets the road.
So let's kick things off with the prepared remarks. Before the analyst even got a word in, what was the big message from the top?
Well, CEO ArcelorMittal started with something that, often gets glossed over as corporate speak, but in heavy industry, it is vital. Safety? He detailed their 3-year safety transformation plan.
Okay.
He emphasized that over the last year, they have seen measurable progress. All their key performance indicators, or KPIs, are improving, but he specifically highlighted progress in fatality prevention.
That's huge.
Yeah, and he framed this not just as a metric to hit, but as a social transformation that is essential to their license to operate.
Which sets the cultural tone. But immediately after that, he pivoted to the macro environment. And this is where I saw the term level playing field come up repeatedly. It sounds like they're feeling more protected than in the past.
Yes, and this is the trade policy argument. If you take one thing away from the macro setup, it's this. The European Commission has implemented 2 major tools. First, the Carbon Border Adjustment Mechanism known as CBAM.
The CBAM, right.
And second, the Tariff Rate Quota, or TRQ.
Okay, let's pause there because those acronyms are doing a lot of heavy lifting. What do they actually mean for the business?
So think of CBAM as a carbon tax at the border. If you want to import steel into Europe from a country with, let's say, lax environmental laws, you have to pay for the carbon emissions, just like a European producer does. It prevents dumping of cheap, high-carbon steel. And the TRQ, that just limits the actual volume that can enter before hitting really high tariffs. ArcelorMittal's point was that these measures finally stop unfair competition. It resets the profitability baseline for the European steel industry.
So it's not just a European thing then?
No, and he noted that. Canada and Brazil are making similar moves to protect their domestic markets.
So the regulatory moat is getting wider, but they aren't just sitting back and letting the government protect them, right?
Yeah.
Where's the growth coming from?
Not at all. They highlighted that their strategic projects are now contributing real money. Specifically, these projects added $1.6 billion to their EBITDA.
Wow.
Yeah. They are heavily focused on the energy transition, investing in renewables, and electrical steel capacities, which are essential for electric vehicles.
And that brings us to the numbers. I'll take this part because I love a good balance sheet. For the full year 2025, they delivered an EBITDA of $6.5 billion. But here's the number that jumped out at me. They generated $1.9 billion in investable free cash flow.
That is significant.
And if you zoom out, since 2021, they've generated $23.5 billion in investable cash. That is a staggering amount of liquidity. And they're giving it back to shareholders. They doubled the dividend to $0.06 per share. And get this, through share buybacks, they have reduced the total share count by 38% over the past 5 years.
That is a massive consolidation of value. It means every remaining share owns a much larger slice of the company.
It really is. And for the 2026 outlook, they were optimistic. They expect higher steel production and shipments across all regions and are confident they'll keep generating positive free cash flow.
So strong financials, favorable policy shifts, and a focus on safety. That was the pitch.
That was the pitch. But then came the analysts, and they were ready to grill them. We're going to go through these chronologically because the sequence really reveals what the market is worried about. First up in the queue was Elaine from Morgan Stanley.
Right. Elaine went straight for the operational reality in Europe.
He had a two-part question. First, with this industry structure changing in Europe, thanks to those trade policies we mentioned, how quickly can ArcelorMittal bring their idle capacity online?
Right.
And second, he wanted a profit bridge. Basically, how do we get from Q4 2025 profitability to Q1 and Q2 of 2026?
The company's response regarding speed was quite specific. They are targeting July 1st. That is when the new tariff rate quota period kicks in. They have facilities in Fos, France, and a new electric furnace in Gijón, Spain, that they can ramp up. But, and this is important, they added a crucial caveat.
Which was?
Profitability. They called customer demand their signpost. They said they won't just add capacity for the sake of it. It has to be profitable. They aren't going to flood the market if the orders aren't there.
Smart. And on the profit bridge?
Management explained that Q1 is going to see a recovery in North America. Remember, they had some operational issues in Mexico that are now resolved, so volumes and prices there will go up. For Europe, shipments will go up in Q1, but the price improvement, the benefits of higher steel prices, is really going to be a Q2 phenomenon. So expect a staggered recovery.
Okay, so North America leads the charge in Q1, Europe follows in Q2. Next up, we had Tristan from BNP Paribas.
Tristan stuck with the European theme, but looked at the longer term. Decarbonization.
This is always the big anxiety, right?
Yes.
Is going green going to bankrupt the company? He asked about the timeline for projects like Dunkirk and whether the current CAPEX guidance, that's the budget for upgrades of $4.5 to $5 billion, would need to increase.
And he also asked for their view on the ETS, the emissions trading system reform.
Right.
The company held the line on the budget. They reassured everyone that the $4.5 to $5 billion guidance is safe. They plan to do these projects sequentially, one after another, so they don't blow the budget or overburden their resources.
And on the emissions trading system.
This was a fascinating answer. Management basically said the world is waking up to the fact that steel is critical for national security. Europe cannot afford to deindustrialize. They argued that the ETS needs to adapt to reality. Energy costs in Europe are still high, and the transition pace is physically slower than the system was designed for. But they emphasized that CBAM is the equalizer. It ensures they aren't penalized for being cleaner than imports.
It's interesting to hear them talk about steel as national security. That's a shift in rhetoric. Moving on, we had Ephraim from Citigroup. He took us on a world tour.
He did. He asked about India, Brazil, and the U.S.
Specifically, is the expansion study at Hazira in India for the planned 15 to 24 million tons or something beyond that?
Yeah.
In Brazil, are they capped out on M&A because they already have such a high market share?
And the U.S. furnace, right.
And finally, when will the second furnace at Calvert in the U.S. be approved? 3 distinct regions. How do they handle that?
A very systematic breakdown. For India, they clarified that the current expansion takes them to 15 million tons by 2027, but they are working on a separate greenfield facility on the East Coast that would add another 8 million tons. The long-term vision is huge, over 40 million tons.
Wow. And Brazil.
They sort of shut down the M&A idea. They said they are happy with their current assets, Tubarão, Pisum, Vega. The focus there is organic growth and downstream capabilities, not buying competitors.
Okay. And the U.S. furnace.
Not happening immediately. They said the approval for the second furnace at Calvert isn't an immediate term event. They're focused on ramping up the existing electric arc furnace first.
Got it. So, aggressive growth in India, stability in Brazil, and patience in the U.S. Next question came from Cole at Jefferies.
Cole went back to the opportunity in Europe.
Right. He pointed out that there are about 10 million tons of imports being displaced in Europe because of these new tariffs, he asked. How much of that can ArcelorMittal capture?
And does it cost them anything to do it?
Exactly. Do they need to spend money to capture it? And what's the trigger to ramp up?
This was a very confident response from the company. They noted that about 8 million tons of that displacement is flat products, which is their wheelhouse. ArcelorMittal has about 30% market share, and they fully intend to capture that growth.
And the cost?
0 significant new CAPEX. They said the $4.5 billion guidance covers it. They don't need to build new factories. They just need to turn the machines back on.
And the trigger?
The order book. Simple as that. If the customers call, they run the mills. They also mentioned they have flexibility to bring in slabs, semi-finished steel from Brazil to help European production if things get tight.
That's a strong position to be in. Next, we heard from Reinhardt from Bank of America. He wanted to talk about the cash.
Always follow the money.
Exactly. He noted that the dividend doubled, but the share buyback slowed down slightly. He asked if this signaled a shift in strategy.
And he tried to pin them down on a demand number for Europe.
Yeah, seeing as the economic indicators are turning positive.
Management was very clear, no change in strategy. The framework is still to return at least 50% of free cash flow to shareholders. The dividend increase just reflects their confidence. But they explicitly stated that buybacks remain the preferred tool for returning cash.
Which makes sense if they think their stock is undervalued. And on the European demand number.
They dodged it, but for an interesting reason. They declined to give a specific number because they argue that trade policy is now a bigger driver of their shipments than actual consumption trends.
Oh, that's a good point.
Basically, it doesn't matter if overall demand grows only 1%, if imports are cut by 20%, ArcelorMittal's slice of the pie gets bigger. They did mention positive dynamics in infrastructure and, interestingly, defense spending related to NATO targets.
Defense spending again. That security theme keeps popping up. Next was Bastian from Deutsche Bank.
Bastian asked two big strategic questions. First, does Europe need more consolidation, meaning fewer, bigger steel companies? And will ArcelorMittal play a role?
And second, what's the stance on Russian material, specifically slabs, with these new trade defense instruments?
Heavy topics. On consolidation, ArcelorMittal said they are comfortable. They don't need M&A to gain scale or fixed costs. They are big enough.
And on the Russian slabs?
This is a nuanced regulatory point. Currently, slabs, which are, semi-finished blocks of steel, are not part of the tariff rate quota.
Oh, really?
Yeah. However, the European Parliament has published a paper demanding a ban on Russian slabs. The Commission hasn't adopted it yet, but the pressure is there.
So watch this space. If that ban hits, the market tightens even more. Next, we had Matt from Goldman Sachs.
Matt was digging into the discrepancies in the numbers.
He noticed that the strategic CAPEX spend was below guidance in 2025, yet they still delivered the EBITDA uplift. So he asked if spend was just deferred.
And he also asked about the expansion in Liberia. What are the limitations to getting that up to 30 million tons?
Right.
The company explained the CAPEX miss. It was just a timing issue. About $200 million related to the Liberia Mineral Development Agreement extension was pushed to Q1 2026. No projects were canceled or delayed.
Okay, so just a shift. And the Liberia expansion.
Good news there. They said the rail infrastructure can actually handle 30 million tons with minimal investment, mostly just buying more rolling stock, the train cars themselves. They're currently studying how to expand the mine to that level at a low capital cost.
Efficient. Next up was Timna from Wells Fargo.
Timna played devil's advocate. She asked about risks.
She asked if there are high risks regarding trade protections in places like India, Mexico, and the U.S. And she also asked about substitution. Is there a risk that manufacturers will switch from steel to aluminum in Europe because steel prices are getting too high?
Good questions. On the trade risk, management was fairly relaxed. They said governments in India and Brazil are actively supporting domestic steel for security reasons. Plus, in India, the market is growing at 6–8%, which offsets a lot of trade friction.
And the aluminum substitution risk.
They aren't seeing it. They said there is no significant demand destruction. Their focus is ensuring their customers, like auto manufacturers, remain competitive. And they actually expect future trade protections to extend to those downstream industries to prevent carbon leakage.
You mean protecting the car maker, not just the steel maker?
Exactly. That would be a massive policy expansion.
Wow. Okay, getting near the end here.
Yeah.
Phil from KeyBank was next.
Phil wanted the nitty-gritty operational data.
He asked about operating rates at Calvert in the U.S., how much volume is coming back in Mexico after their outages.
And that DNA number.
Right. He noticed a spike in depreciation and amortization in Q4, and he wanted to know what to model for 2026.
The company said the electric arc furnace ramp-up at Calvert is progressing. Expect full capacity by the second half of the year. In Mexico, the longs business, that's beams and rebar, is back, adding about 2 months of production in Q1.
Yeah.
The flats business is also back after 1 month of maintenance.
And that accounting spike.
One-off event. End-of-life asset correction. They guided for $2.9 to $3.0 billion in depreciation and amortization for 2026. So back to normal.
Finally, we had Max. No firm specified, but he had some targeted questions.
He asked for an update on ILVA and the financial impact. He also asked for feedback on the CBAM implementation and if people were cheating the system.
And the India financing, right?
Had financing for the India Greenfield project.
And the responses.
On ILVA. No provisions recorded because the company believes the case has no merit. It will likely take years to resolve. On CBAM, spot prices are starting to reflect CBAM costs. No evidence of circumvention or resource shuffling yet.
In India.
On India financing, focused on minimizing funding costs. We'll update later.
And that wrapped up the Q&A.
A very comprehensive session.
So let's pull this all together. We've heard the pitch, we've heard the grilling. What are the big picture takeaways here?
I think there are three main themes that every listener needs to walk away with. First is structural improvement. This company is generating significant cash, $1.9 billion, and doubling dividends even before the market has fully recovered.
That's the cash machine theme. What's number two?
The trade policy reset.
Yeah.
I mean, the narrative has shifted from just market demand to security and fair trade. Europe's new tools, CBAM and TRQ, are a game changer for profitability. It puts a floor under the market.
And the third?
Growth. They aren't just cutting costs. They have a strong pipeline in India, Brazil, and renewables that is already delivering EBITDA uplift. They are playing offense and defense at the same time.
Playing offense and defense. I like that. It sounds like ArcelorMittal is positioning itself to be a winner in this new, more protected global economy.
It certainly seems that way.
Well, that brings us to the end of our breakdown. We hope this gave you a clear view of where ArcelorMittal stands as we head further into 2026. If you found this breakdown helpful, please click the like button, share this video, and subscribe to stay tuned for upcoming content. We'll see you next time.
Thanks for watching, everyone.